Okay, study objective 2 and 3 coming up here. To record transactions, we are going to use what's called accounts. And every company has a set chart of accounts that they establish. It's not the same across all companies, although there are a lot of common ones that do exist across most companies. But they use individual accounts in this chart of accounts to record transactions. The account kind of looks like this. It's got a title, so cash or accounts receivable or equipment or revenue, wages, expense. All of those things would be titles and individual titles of the account. And then there's a left side called a debit side and a right side called a credit side. And what we're going to do to record transactions is we're going to learn what the effect of a debit to a certain kind of account is, what the effect of a credit to a certain kind of account is, and you're going to get used to debiting and crediting individual accounts when you need to increase them and decrease them. So, and by the way, here at the end of every study objectives, there are these tutorials. They're interactive tutorials where the screen pops up and this guy kind of reads things to you and shows you examples of things. So you might want to try some of these out, especially with the more complicated topics that you come across. In study objective 3, we introduced the concept of debits and credits. In study objective 1, you had a bunch of transactions for this pretend company that showed you a bunch of increases and decreases to the cash account, coming to a balance of 15.2 in cash. What we're going to do instead of increases and decreases, we're going to debit and or credit accounts for transactions that cause them to go up or down. So you can see here, cash, since it is an asset account, you'll learn this as we go on, but since it's an asset account, it requires debiting of it to increase it and crediting of it to decrease it. So for every one of these increases over here, we have a debit to cash, and for every one of the decreases, you see a credit to cash. So then the way the T account works is everything on one side is added up and everything on the other side is added up. Then you basically subtract the two, one from the other, depending on which one's greater. And whichever one's greater, that's going to be the balance in the account. So all this adds up to like 27,000. This adds up to like 12,000 or something. So if you subtract the two, you end up with $15,200 debit balance. And cash is always going to have a debit balance which is called this normal balance, because you can't really have negative cash. And so for all of our accounts, we're going to have what's called that normal balance, where you get used to seeing a certain kind of balance. So as we kind of peruse down here, you can see this. Here's the starting discussion for normal balances. Assets with a normal debit balance. Liabilities have a normal credit balance. So you can see kind of right here at these illustrations what normal balance would exist for certain kinds of accounts. And then hopefully it makes sense to you to see that if an account has a normal balance of a debit in this case, then debits are what you do to increase that account, and credits would be what you do to decrease that kind of an account. And conversely, liabilities, they have a credit normal balance. So if you ever want to increase a liability, you would want to credit it, and if you want to decrease a liability, you would debit it. Stockholders' equity, you're going to look through some of this stuff too. Common stock is an equity account, so it's going to have a normal credit balance. So it'll increase the credits, it'll decrease with debits. Retained earnings, same thing, is an equity account, increases with credits, decreases with debits. You have to recall, though, that retained earnings is comprised of dividends and revenues and expenses. So dividends have a normal debit balance because they reduce retained earnings, so they should have the opposite theory as retained earnings. Revenues increase retained earnings, so they should be the same as retained earnings, and in fact they are. Revenues are credits normally, and so you credit them to make them go up, but expenses reduce retained earnings by reducing net income. So that has the same effect as dividends on retained earnings, so expenses you'll see are debits, and we're going to debit them to make them go up. So really get to understand these ideas with debits and credits, and you can kind of see more pictures down here showing us the same kinds of things. And again, here's the tutorial if you have trouble with this section.